Hello and welcome to today's video. This is the third video in our recent series looking at how to invest so that crashes don't matter, arguably of particular relevance at the moment as I'm recording this. As a quick reminder, in our last two videos, we've looked at firstly, the crucial importance of investing for the long run and ideally the very long run, and secondly, the merits of investing regularly each month and automating your investments. Today, we move on to our third related topic, and that is the idea that you should completely ignore the news and as part of that, stick to your guns when it comes to investment. This is true when it comes to investing. Trading is very different, of course. And if you want a reminder of that very important difference between those two things, please do check out our video on the subject from back in January. But our entire focus in this video course is on investing, not on trading. So moving along, as I said in our last video, when it comes to investing, contrary to what so many people think, the more you pay attention to the news and to financial market movements, the lower your returns are likely to be, and the more likely you are to lose money too. This is the topic we're going to look at today. So across several of our previous videos in this series, we've already seen the importance of the big picture and the long game, and of owning human progress when it comes to investment success. The news is largely irrelevant to that big picture and that long game, and to human progress in the long run, over many decades at least. In fact, it's even worse than that. The more you pay attention to the news, the more likely you are to fall foul of the many problems with human psychology we've looked at in recent weeks, which make you a bad trader and make you buy high, sell low, and reduce your investment returns or even cause you to lose money. As a reminder, most investors make much lower returns than the market. And lots of people lose money when they attempt to invest in the stock market for all of the reasons we're covering in these videos. Even worse, for tens of millions of people, and for our society as a whole too, of course, most people aren't investing at all, and so they don't make any investment returns. And I happen to think this is one of the biggest problems we confront as a society today for what it is worth. But I digress. Since I published my first book, people regularly get in touch with me to say something like, "Thanks so much for your book. Having read it, my wife and I really want to start investing, but we're really worried that now is probably a bad time because of coronavirus, or Brexit, or Iran, or the situation in Gaza and Israel, or Trump, or lots in the news at the moment about a possible stock market crash, and so on and so on." And then they say, "When do you think we should start investing, please?" And my answer is always the same. Stop thinking about the news and stop thinking about any kind of right time to invest, because the right time for you to start investing, if you haven't done so already, is almost certainly right now and for the rest of your working life. Coronavirus was, and arguably still is, a massive story. And you might say the same about Brexit. The situations in Ukraine and Gaza and Israel at the moment are another couple of big stories. So is an ongoing sort of trade war between the US and China, and the China-Taiwan situation is yet another one. And as is the potential impact on all of the above of the forthcoming US election, of course. But truly, if you were to go back through every single year since journalism was invented, you would realize that there are similar big stories week after week, month after month, and year after year. And this is because this is how the media makes money. News editors and journalists say things like blood sells, or if it bleeds, it leads. And this is why essentially all newspapers and TV channels focus 99.99% of their attention on the 0.01% of bad things that are happening in the world today. As Elon Musk has put it, the news tries to answer the question, what's the worst thing that happened on Earth today? Crucially, this gives everyone a heavily distorted view of the state of the world as a result, and arguably more important for our purposes in these videos, by extension, their view of financial markets. A few years ago, I wrote an article where I said, people who have taken no time to study it or to really understand it think that the stock market is horribly risky. And this is perhaps unsurprising given that the media goes absolutely bananas every time there is a massive crash. And so that is most people's reality when it comes to stock market investment. The majority of the time that a sensible, diversified portfolio will gradually and entirely effectively build your wealth never makes front page news. I've also written about how human beings are hardwired psychologically to focus on the extraordinary to the exclusion of the unremarkable, and how this reality is particularly relevant to investment and a big part of the reason so many people fail at it. When financial markets crash, you will see loads of headlines saying things like £120 billion wiped off shares in a day. What you will never see is a headline that says, the global economy has grown 670% since 1985. The gradual and significant increase in wealth that comes from investing over many years and sticking to your guns never makes the front pages of our newspapers. And no television presenter ever says, great news, the stock market has increased by 3% this month. And as a result, most people have a horribly distorted view of and understanding of financial markets. And this is incredibly damaging to their chances of becoming wealthy. The most effective solution to this reality is to understand it, believe in human progress, automate your investments over long periods of time, and completely ignore the news. Taking this approach will very likely increase your investment returns, quite possibly by several percentage points on average a year. And this can have a life-changing impact on your ability to become wealthy over time. Perhaps more important still, it will reduce the administrative burden of your financial affairs and likely bring you real peace of mind. Regular automated investment and ignoring the news removes a great deal of stress and hassle, and I would argue even helps you sleep at night, once you know what you're doing and you're confident at least. It also increases the chance that you actually get your finances sorted. This is one of the most important considerations when it comes to investment, given how many people never do. You have to be in it to win it, after all, as with so many other things in life. The lesson of history is that sticking to your guns with confidence over very long periods of time will increase your chances of success. As Warren Buffett has put it, lethargy bordering on sloth remains the cornerstone of our investment style. Or, as his right-hand man Charlie Munger famously joked when it comes to investing, don't just do something, stand there. For what it's worth, I would argue that anyone invested this way, who has the self-discipline to ignore the news along the way, as I'm suggesting, has very likely enjoyed wonderful peace of mind and a generally sunnier disposition too. Following the news is one of the main reasons that most people do so badly with investment, and is demonstrably bad for our mental health too. There's a great deal of academic and real-world evidence that you should totally and utterly ignore the news when thinking about long-run investment. Whatever may or may not be happening in the world at the moment, the evidence of history is very consistently that you really don't need to worry in the slightest about nearly all of the news stories of the day, such as Ukraine, Gaza, coronavirus, Brexit, Trump, or trouble in the Straits of Hormuz again. Not when it comes to your investments, at least. To live a good and prosperous life, and with far less stress than most people seem to be suffering these days, you need only arrange your financial affairs to benefit from mankind's inevitable progress in a vaguely sensible way and leave well alone for many years. You must have confidence in your game plan and stick to your guns. And of course, this is far easier to do once you understand more about finance, given how much more confident you will be about what you're doing. What is really important to stress again here is the importance of the very long run and of doing this over long periods of time. To maximize your chances of success, you really do need to invest consistently over many years, ideally at least 20. When it comes to investing, patience gives you a huge advantage. Another reason so many people fail at this is because they just aren't patient enough and they don't give the whole process enough time to work. This is why it's so important to set up something automatic alongside everything else you do in your life and just let it run its course. So often over the years, I've had people get in touch with me who have only been investing for 2 or 3 years, or in some cases, even for only a few months or weeks, and who are disappointed that they haven't seen more progress yet, or even that they currently have less than they started with. Often, such people are considering giving up on investment. And this is one of the most important things to fight. The bad news is that building wealth invariably does take a long time. But the good news is that if you are willing to be patient and really commit to the process, the results can often be far beyond what most people think is possible. It's important to stress that stock market returns are not smooth or consistent. A great deal of performance might come every few years over relatively short periods of time, for example. Because of this, you want to ensure that you have as much capital invested at all times as you go, to ensure you capture that upside when it comes. And this reality is referenced in a reasonably well-known phrase in investing circles, which talks about time in the market and not timing the market. It's really important to keep going for a very long period of time to ensure that you get the best result possible, and don't be scared out of your positions by the news. As an example of how this can work, imagine your average investment returns were as bad as 0 for as long as 10 years. You saved money each month but didn't earn any positive real investment return at all over an entire decade, perhaps as the market went up and then down and then back up again, which can and does happen, of course. But say in that time, you managed to save £500 a month on average, so perhaps £250 each for a married couple working as a team. This would mean that at the end of that decade, you would still have a pot of £60,000. So that's £500 times 12 months times 10 years. Crucially, imagine too that you kept at it and kept your pot allocated to the stock market, and then the market suddenly had 3 really strong years in a row. This actually happened from 2019 to 2021, so let's use that as an example. In those 3 years, the S&P 500 was up around 31.5%, 18.4%, and 28.7% respectively. And in this example, if you'd started 2019 with that £60,000, 3 years later, you'd have more than £120,000. Your $60,000 would have grown to $78,900 in 2019. Then it would have grown to just over $93,400 in 2020, and then you would have got to just over $120,000 in 2021. In fact, fast forwarding another 2 years through 2022 and 2023 is quite instructive here. In 2022, the S&P was down just over 18.1%, and then up about 26.3% in 2023. So that 120,000 pot that you built by the end of 2021 would have fallen back to just over 100,000 through 2022, but then grown back to more than 128,000 a year later. And in fact, you'd have tens of thousands more than this, assuming you'd continued to put that £500 a month to work over those 5 years, of course. This is why having confidence in what you're doing and sticking to your game plan over many years is so important. And it's what I mean when I say that investment success is so often much more about admin and habit and consistency than it is about what you invest in within reason. I think it's important to highlight another final point here before signing off today. And that is just how often financial market performance is in no way correlated to the performance of the real economy. Put another way, there is far less of a clear relationship between Main Street and Wall Street than many people think. This is another reason to ignore the news. So I've just shown how the US stock market increased by 18.4% in 2020 and 28.7% in 2021. So as the coronavirus crisis was raging around us and lockdowns were wreaking havoc with people and economies all over the world, the US stock market had 2 exceptionally big positive years. How many people do you think know this? And if you'd asked the average person with no knowledge of investment whether that would have been a good time to invest in the stock market, most people's answer would have been a resounding no, as I'm sure you will agree. More often than not, the performance of the stock market bears very little relationship to what is going on in the news or even what is happening in the economy. Too many people think that if there is a recession, there will be a stock market crash. Another reason people avoid investing. But this is a very simplistic view, which the evidence of history shows us is often entirely wrong. And in fact, there are plenty of professional investors, talking heads, and financial advisors who get this wrong too. Far more important than trying to work out what may or may not happen based on the news or what the real economy seems to be doing, successful investment is about doing something every month, forever, from the moment you can afford to for your entire working life. And the final piece of the puzzle is to make sure that you're in the right mix of assets over time, something we're going to look at in our next video. If you've actually made the effort to set up an investment account with a good quality company, optimize your ISA and pension arrangements, and set up the necessary regular direct debits, you will be 90% of the way to investment success. And the final 10% is about choosing that something sensible to make those payments into and sticking to your guns over many years. As a final comment here, this is also the first thing you should focus on when it comes to your money and finances. Regular automated payments into sensible investments in your pension and ISA accounts with 10% or more of your monthly income every month forever should be a much higher priority than any kind of trading or putting money into things like crypto, for example. If you want to trade and or invest in crypto, then by all means look into that, but only after you've sorted out this more fundamental stuff first. We will return to this topic again in a future video. So that's it today on the subject of ignoring the news. In our next video, we're going to look at the crucial importance of getting your mix of investments roughly right based on your age by using an elegant idea called 100 minus your age, which has been around for a few decades. So as ever, if you want to ensure that you're one of the first to see our videos when they're published, and as we go through these crucial next few steps, please do click the subscribe and bell buttons. I'd also like to repeat what I said in my last video, that if you haven't already, please do feel free to connect with me on any or all of LinkedIn, Facebook, and Twitter, or X. I post 2 of these videos a month, but I tend to post far more regularly on social media, so if you'd like to get more from me and from Plain English Finance, do please connect. And we also have an email list which you can subscribe to for free. You just need to put your name in a box on the landing page of our website, which is plainenglishfinance.com or plainenglishfinance.co.uk. Until next time, I wish you the very best.